Welcome back to the Deep Dive. We've got a stack of research today that is, honestly, a little bit unnerving.
In that better to know now kind of way.
Exactly. We're digging into retirement, but we are not talking about asset allocation or, picking stocks.
Yeah.
We're talking about the bill.
A bill that comes due just when you think you're done paying.
Yes. And to kick this off, I want to challenge a premise that I think most of us just, well, we accept it as gospel. It's that standard advice you get from HR when you sign up for a 401k. Defer your taxes now. Put the money away pre-tax, because when you retire, you'll automatically be in a lower tax bracket.
It's the default setting for American retirement planning. It's been the mantra for 40 years.
But is it true? I mean, looking at the materials we have today from the team at Confidence Financial Partners, that advice feels shaky.
Maybe even a little bit dangerous.
Dangerous is a good word for it. The assumption that your taxes will be lower relies on two things, right?
Right. One, that you'll have less income, and two, that the government won't raise tax rates. The advisors at Confidence argue that for many successful savers, neither of those things might be true.
They call this the tax time bomb, which is a pretty dramatic image.
It is, but it fits. Think about it. You're stuffing money into these tax-deferred accounts, 401ks, IRAs, year after year.
You feel smart because you're lowering your tax bill today.
Exactly. But you are just packing tax liability into a pile, and the fuse is set for your 70s.
Because that's when the IRS comes knocking.
Right. And the risk is that the explosion, that tax bill, might be much larger than you anticipated, potentially eating up a huge chunk of the wealth you wanted to leave behind.
So our mission today is to decode what the Confidence team calls the tax triangle. We're going to look at why taxes might actually go up and then walk through the strategies they outline to try and defuse this bomb.
Sounds like a plan.
But before we get to the solution, I want to push back on the problem a little.
Okay, play devil's advocate. Go for it.
Well, we always hear taxes are going up, but politicians, they love getting elected. Raising taxes, usually political suicide. Is this just fear-mongering? Why does the Confidence team think the government is coming for our 401ks specifically?
That's a fair question. And to answer it, we have to zoom out to the macro context. The advisors at Confidence point to the national debt.
Which is big. I saw the number $38.6 trillion in the notes.
It's $38.6 trillion, yes. But the scary part isn't the total number, it's the velocity.
Great.
It's growing by $2 to $3 trillion annually.
Yeah.
We are adding $1 trillion of debt every few months now.
Okay, but the government can, print money. We've had debt forever. Why does it matter now?
Because of who holds the wealth. And the Confidence team makes a really startling comparison here.
Okay.
On one side, you have a government that's $38 trillion in the hole. On the other, you have the baby boomer generation. Do you know how much net worth boomers are sitting on?
I assume it's a lot, given the housing market and the stock market.
It's approximately $88.5 trillion. That is roughly half of all the net worth in the entire United States.
Wow. Okay, so you have a broke government on one hand and a massive piggy bank on the other.
Exactly. It's a logical deduction. If you're the government and you desperately need revenue to service that debt, where do you look?
You look where the money is.
You don't look at the people with no money. You look at the largest accumulation of liquid wealth in history. And for the U.S., a huge part of that is in retirement savings.
That makes a kind of cynical sense. The Confidence team uses an analogy that I thought was perfect. They say the IRS is a silent partner in your 401k.
It's the best way to visualize it. Think about it like a business deal.
Okay.
You put up 100% of the capital. You took 100% of the risk in the market. You suffered through the volatility. But because you haven't paid taxes on that money yet, the IRS owns a percentage of your account.
But here's the kicker, and this is what gets me. You don't know what their percentage is.
That's the problem. It's like having a business partner who says, I'll let you know what my split of the profits is after you sell the business.
And they can change their mind whenever they want?
Unilaterally.
Yeah.
Just by voting on a new tax bill.
That is wild when you think about it. We are saving in a blind trust where the other guy controls all the math.
Pretty much.
Okay, so that's the threat. The government needs cash, retirees have it, and the IRS has the keys to the account. Now let's get practical. The Confidence team breaks down our money into 3 buckets. They call it the tax triangle.
And visualizing this is crucial. Just imagine a triangle. Every single dollar you own falls into one of 3 buckets based on how it's taxed.
Bucket number 1. They call this the always taxed bucket, and they even label it the danger zone.
This is where most people have the bulk of their wealth. This is your ordinary income bucket. It includes your traditional IRAs, your 401ks, your 403bs,
And for federal employees, they're TSPs.
TSPs, right.
So why is it the danger zone? I mean, I know I have to pay taxes, but isn't that just part of life?
It's the danger zone because of the lack of control. The confidence team really emphasizes that word, always.
Always taxed.
If you withdraw this money to buy groceries, taxed as ordinary income, if your spouse inherits it, she pays ordinary income tax on every dollar she touches if it goes to your kids.
They pay ordinary income tax.
Always.
And this is where we get back to that time bomb idea. The required minimum distributions.
RMDs, yes.
Hmm.
This is the government's mechanism to force that tax revenue out of your account. Starting in your early 70s, currently age 73, the government says, we're done waiting.
Time to pay up.
They force you to withdraw a percentage of this account every single year, whether you need the cash or not.
And this is where that lower tax bracket myth really falls apart, isn't it? Because if you have a couple million in a 401k, that required withdrawal could be huge.
Precisely. We aren't just talking about paying a little tax. That forced income can push you into a much higher bracket, but it gets worse. It can trigger what are sometimes called stealth taxes.
Stealth taxes.
Things like the taxation of your Social Security benefits, or something called IRMAA.
IRAAA. That's the Medicare thing.
Right. It stands for Income-Related Monthly Adjustment Amount. Basically, if your income spikes on your tax return, say from a big RMD, Medicare looks at that and says, oh, you're wealthy. And they can double or even triple your Part B and Part D premiums.
So it's a success tax. You saved well, so now your health insurance costs more.
That's one way to look at it. And it can create this domino effect that really erodes your spending power.
Okay, that's bucket one, the always taxed trap. Let's move to bucket two, the sometimes taxed bucket.
This is your capital gains bucket. Think of assets like real estate, stocks held in a regular brokerage account, businesses, that kind of thing.
So how is this better than the 401k bucket?
Well, while you might pay tax on interest and dividends as income, the growth, the appreciation, is taxed at capital gains rates. And historically, capital gains rates are significantly lower than ordinary income tax rates.
Okay, that makes sense. But there's a specific term in the notes here that seems really important for estate planning. Step-up in basis. Can you explain that in plain English?
This is a massive benefit for bucket two. Let's say you bought a stock years ago for $10. Today, it's worth $100.
Yeah.
If you sell it while you're alive, you pay capital gains tax on that $90 gain.
Sure. Makes sense.
But thanks to the step-up in basis, if you hold that stock until you pass away, your heir inherits it at the current market value, the $100.
So what happens to the $90 of profit?
For tax purposes, it vanishes. Your heir can sell it for $100 the next day and pay zero capital gains tax.
That is a huge difference compared to the 401k, where the kids inherit the tax bill right along with the money.
It is. And the advisors at Confidence point out a common mistake here.
What's that?
Retirees often drain this sometimes taxed bucket first because they want to, protect their IRA. But mathematically, they might be spending their most tax-efficient money and leaving a fully taxable bomb for their children.
That is a really counterintuitive point. Okay, so bucket two is better. But then we have bucket number three, the never taxed again bucket.
This is the destination, but we have to be very precise about what lives in here.
Right. Material lists two specific vehicles, Roth IRAs and properly structured cash value life insurance.
Correct. Let's start with the Roth. You pay the taxes on the seed, the money going in, but the harvest, the growth and the withdrawals, those are 100% tax-free.
And no R&Ds.
That's the best part. For the original owner, there are no required minimum distributions in a Roth IRA. You are in control. The government can't force you to take the money out.
Now let's talk about that second item, properly structured cash value life insurance. I feel like life insurance gets a bad rap sometimes.
It can.
People just think of it as a death benefit. Why is it in the never taxed again bucket?
It's a complex instrument, and that key phrase is properly structured. The Confidence team isn't talking about buying a policy just to pay out when you die. They're talking about overfunding a policy so that cash value can accumulate.
And how do you get that money out tax-free?
You generally access it through loans against the policy, not withdrawals. And since a loan isn't considered income by the IRS, it's not taxable. It can function very similarly to a Roth if it's set up correctly, but with different rules and costs.
Got it. So it's a tool, not just a safety net. So the whole Confidence retirement pathway seems to be about moving money from that always taxed danger zone
into this never taxed again sanctuary.
Exactly. defusing the bomb.
That's the strategy.
But here's the friction point. To move money from a 401k to a Roth, I have to do a conversion, which means I have to pay the taxes on that money now.
Mm-hmm.
Why would I volunteer to pay taxes today?
That is the million-dollar question. And the answer is entirely about the historical window we are in right now. The Confidence team notes that current tax rates are at 65 to 70-year lows.
Right, from the Tax Cuts and Jobs Act.
We are in a valley of low taxation, historically speaking. So the logic is simple. Would you rather pay taxes on the seed today at a known historically low rate, or pay taxes on the whole harvest later at a rate that, given the national debt, could be much, much higher?
Okay, but you can't just move it all at once, right? If I convert $1 million today, I'm writing a massive check to the IRS.
Right, and you'd push yourself into the highest possible tax bracket. You'd defeat the purpose. The strategy is called systematic Roth conversions.
Walk me through the math of that.
Think of your tax brackets as literal buckets. Let's say you are in the 22% tax bracket, and the top of that bracket is $190,000 of income for a couple. But your actual income is only $140,000.
So I have a gap there.
Exactly. You have $50,000 of room before you hit the next bracket, which might jump to 24% or higher. The strategy would be to convert exactly $50,000 from your 401k to a Roth.
I see.
You fill up that cheaper bucket perfectly, paying 22% now to help ensure that money and all its future growth is never taxed again.
You're topping off the tank while the rate is known. And there's a very specific time-sensitive opportunity the Confidence team highlights about Social Security that makes this even more compelling.
Yes, the Social Security bonus or a senior deduction. This was news to me.
Me too.
This is a really critical window, 2025 through 2028. During these years, there is a bonus standard deduction for seniors over 65. It's an extra $6,000 for single filers or $12,000 for couples.
Okay, $12,000 is nice, but how does that change the game?
Well, when you combine that bonus deduction with the standard deduction, the Confidence team suggests that many retirees might pay zero federal tax on their Social Security income during this window.
So your baseline income on your tax return is effectively lower.
Exactly. And because your taxable income is lower, you have more room in those low tax brackets we just talked about. It opens up a wider lane to do those Roth conversions at a potentially lower cost.
But the clock is ticking. You mentioned 2028.
That's when the current tax laws from the Tax Cuts and Jobs Act are set to sunset. Unless Congress acts, tax rates automatically revert to their pre-2018 levels, which were higher.
So we have a planning horizon of about 4 years.
That's what the advisors at Confidence suggest. In Washington, nothing is forever. And with the debt pressure we discussed, betting on tax rates staying this low indefinitely is a high-risk gamble.
Okay, the logic holds up. But before anyone listening logs into their brokerage account and hits convert, we need to pump the brakes. What can go wrong?
A lot. And the Confidence team is emphatic about this. Do not do this blindly. Unwinding a tax bomb is precise work.
Give me a worst-case scenario.
You convert too much money in 1 year. You accidentally push yourself into a tax bracket that is higher than what you'd likely pay in retirement. Or you trigger those IRAs surcharges we mentioned, doubling your Medicare costs.
You could actually lose money if you don't do the math right.
You could, and that's why they say, don't let the tax tail wag the dog.
Right. They use a framework called the Confidence Retirement Pathway. It covers 5 worlds: income, tax, investment, health, and estate. And the order matters.
It does. Priority 1 is always income planning. How are you going to live? Do you have the cash flow to pay the electric bill? Priority 2 is risk management. If the market crashes tomorrow, are you okay?
And only then, only after that, do you look at tax efficiency.
Correct. Because being tax-free doesn't help if you run out of money. You have to view it holistically. If you pull a lever in the tax world like a conversion, it moves things in the health world like Medicare premiums. You have to see the whole board.
It sounds like high-stakes chess against the IRS.
It is, but the difference is the IRS writes the rules. The only advantage you may have is that right now, for this brief window, the rules may favor the person who is proactive.
So to wrap this up, we have a national debt spiral that suggests higher taxes may be coming. We have a tax time bomb in our 401ks that forces us to take income when rates might be higher. And we have a temporary window of low tax rates and extra deductions right now.
That's the summary. The choice is yours. You can leave your wealth in the always taxed bucket and hope for the best. Or you can take control and systematically move assets to the never taxed again bucket.
Which again are the Roth IRAs and properly structured cash value life insurance.
That's right.
It comes down to ownership. The Confidence team poses a question that I think is going to stick with me. We spend 40 years working for our money. But if the government can change the tax code with the stroke of a pen, how much of your hard-earned savings actually belongs to you?
It's the ultimate question, and the answer depends entirely on which bucket your money is sitting in when the laws change.
A huge thank you to the team at Confidence Financial Partners for the research and the wake-up call. Whether you find it terrifying or empowering, you can't say you don't know.